Hi, and welcome to Jankin Scott on Risk, the YouTube channel dedicated to the theory and practice of risk management. Today we'll continue our quest to understand translation exposures, which are a frequent source of surprises in firms and can be a serious threat to equity and net income and other corporate bottom lines. So you'll find more information in my book, Corporate Foreign Exchange Risk Management, co-authored with Alviniussen and Uxelheim. There's more information on my webpage, riskbudgeting.se as well. And as they say here on YouTube, please like and subscribe. All right, so translation risk, it's essentially variability in corporate performance from translating assets and liabilities denominated in foreign currency. And it's an important thing here that equity is a residual in the balance sheet. I mean, we translate assets and liabilities, and equity adjusts to that. That's an important point. So a lot of this is about trying to understand how equity is impacted by these translation effects, right? And various financial ratios that make a reference to equity is of course impacted as well. So we have every reason to take this seriously and acquire the right kind of knowledge to predict and manage these effects. But exactly how will equity adjust? I mean, that's the question for this tutorial. I mean, there are translation gains and losses arising, and they will ultimately affect equity, but that can happen in different ways, it turns out, and we'll try to sort that out. And basically, there are two channels for this to happen. One is the one we're most used to seeing and talking about, which is presenting, some profits, and those are accumulating retained earnings. I mean, that's how what we tend to talk about and take an interest in. But there's this other channel involved as well, which is when gains and losses are reported in other comprehensive income instead, which is an alternative income statement. And it gets passed on to a different equity account called translation reserve. So it's still equity, it's just a different equity account, right? So this is a different channel or through which these translation gains and losses can travel through the financial statement, right, and impact equity. So we have these three classic financial statements: net income, cash flow statement, and the balance sheet. But for us to understand this fully, we have to introduce then the other comprehensive income as well, which is a rather mysterious thing sitting just below. If you take a financial report, you'll find it just below net income, right? And it can be hard to say precisely what it is or what it's supposed to be doing. It seems to be mainly about capturing items or gains and losses that the rule makers find problematic, or it would be problematic to report them in net income. So they try to protect net income from all these quirkier, effects of accounting. So they are shown here instead. So that would seem to be the main purpose of the other comprehensive income statement. But together they constitute the total income of the firm. All right, so here you have shareholders' equity in the balance sheet. It consists of many different accounts. You have the classic share capital, the capital injection, retained earnings, treasury stock possibly, and all these different reserves, which are then connected to the other comprehensive income statement. So the first channel then is reporting gains and losses in net income, which is then accumulated here in retained earnings. The other one is when they are reported in other comprehensive income, but accumulate instead in translation reserves. So two different channels through which equity can be impacted, because ultimately they will impact shareholders' equity regardless, right? So that's important to see. So what determines then which of these are you going to be used? Turns out that the answer to that question is whether the asset and liability being translated is monetary or not. So monetary assets and liabilities are treated differently from non-monetary assets and liabilities. The monetary assets and liabilities, those gains and losses are sent into net income and from there on to retained earnings, right? Non-monetary assets and liabilities instead are shown in other comprehensive income and from there passed on to the translation reserve, right? Here's another way of depicting the same thing. You have translation going on of assets and liabilities in foreign currency. So the ones related to monetary assets and liabilities, I mean, pardon the acronyms here, GL is gains and losses, AL is assets and liabilities. So yeah, okay, so over here you have the gains and losses related to non-monetary assets and liabilities, which are treated differently then. So the monetary ones are sent on to net income. In this case, they are instead reported in other comprehensive income. From there on to retained earnings, in this case, translation reserves, but ultimately at the end of the day, they both affect shareholders' equity, right? So we're just talking how equity is impacted, not if or by how much. That we know from the net asset liability position, which is discussed in another video. All right, so what are these monetary assets and liabilities then? Well, these are related to transactions, basically. There's a contract usually involved with a fixed value in terms of the amount of money, units of currency, let's say dollars or euros or pounds or whatever, to be paid or received at a specific date. So it's about payables and receivables in a broad sense, right? Another way of looking is that it's money. I mean, cash is a monetary asset, obviously. And then you have contractual equivalents, like agreements to pay or receive cash at some point in the future. So there's, again, monetary assets and liabilities are basically payables or receivables. That could be as a result of trade. I mean, when we buy and sell on credit, or debt is a payable to the firm owing it, and it's a receivable to the bank that owns the sort of or has lent money to the firm. All right. So, for example, is plant, property, and equipment a monetary asset? No, not exactly. They are part of a set of assets that are required to sustain business operations. I mean, the purpose of a firm is usually to generate cash flows through business activities, right? And PP&E is part of that. You have to have some plant, property, and equipment to function as a firm and be able to be in business, right? So there's no fixed contractual amount to be paid or received at a certain date, right, with PP&E. So the answer is no there. Debt is a monetary liability, on the other hand, because there's a loan agreement involved, specifying when the transaction or the repayment of the loan is supposed to happen and when that is due and all these things. So there's a fixed monetary amount involved and underpinned by a loan agreement here. So yes, that's a monetary liability. So monetary, you have things like cash, debt, trade receivables, trade payables, certain payables related to taxes, etc. Non-monetary would be then property, plants, and equipment, goodwill, inventory, intangible assets, investment in associates. All these things are more embedded in the firm and part of generating future cash flows, in the business. So, all right. So, to understand how net income is exposed to translation gains and losses, we must gather up all these monetary assets and liabilities in a specific currency. I mean, for each currency that we're exposed to, we have to do this, right? Take the net of assets and liabilities in that currency, as long as they're monetary, right? And yeah, that number will indicate the extent to which net income is exposed, and we'll refer to this number as a net monetary position. So let's say we have a Euro corporate group here, a Euro parent, owns a US subsidiary and has 100 in assets or PP&E. So that is something we have to translate right back to euro every quarter. So this the parent company now, not the subsidiary, has borrowed 60 in US dollars. So this debt resides in the parent company, which for ease of exposition here, it doesn't have any operating assets of its own. So we'd calculate the net asset liability position in dollars as the difference between the two numbers, right? I mean, if we're assuming this is all we've got in terms of dollar assets and liabilities, right? So, and as we were able to conclude in that video, the net asset liability position indicates the total exposure to translation effects, how much equity will adapt overall. So it doesn't matter for this calculation whether it's a monetary asset or liability. But if we're interested in the net income exposure, what goes into there, we have to learn more or dig deeper into this by calculating the net monetary position. In this case, we're only interested in monetary assets and liabilities. And since we don't have any monetary assets, this is going to be zero. And the nets will be a negative number. I mean, the bank loan is still a monetary liability, right? So that gets subtracted. So then if the exchange rate starts to change, let's say it's 0.8 initially, then you have a translation here of the PP&E or at 0.8 then, leading to 80 in home currency terms, euros. The debt is translated at 0.8 as well, giving you 48 in home currency terms. All right. As it changes to 0.88, both these items will be retranslated, right, in the next quarter. So I mean, it's a stronger euro now, so it's going to be a gain on the asset, but a loss on the liability, because if your liability is reported at a higher number in home currency terms, that is effectively a loss, right? But because we're talking about a monetary asset and a non-monetary asset and a monetary liability, these gains and losses will be traveling through the financial statements in different ways. So let's look first at this translation gain then, which is the difference between the two exchange rates and the PP&E in this case. So we have a 8 million gain there. We make a similar calculation for debt, so translating it at two different exchange rates, implies a difference, which is applied to this debt then, producing a -5 loss from translation. So the net of those would be 3 then, which is, by the way, predicted by the net asset liability position. This is how much equity has to change overall, given all the liabilities, assets and liabilities in that currency. So this is then how it would be reported in the consolidated financial statements. You would have in net income the loss related to the translation of the debt, because it's monetary. In other comprehensive income, instead, we would record a translation gain related to the PP&E, so being non-monetary. So assets and liabilities, there we would see, first of all, an increase then reflecting the translation gain in PP&E. Similar thing going on here with debt in liabilities. It's translated at a higher or stronger US dollar exchange rate, US dollar euro exchange rate. Sorry. All right, so equity then, starting out, it's just share capital. We have 0 retained earnings and translation reserves. It's all very simple here. Realism is not the point. All right, but in the following quarter then, the translation loss on net income would accumulate in retained earnings. So we're using that channel for this purpose. The translation gain on other comprehensive income, in contrast, will be reported here in translation reserves. They both find their way into shareholders' equity. So the difference is the 3 predicted by the net asset liability position. So it all it all makes sense. So it's just a matter of how these translation gains and losses find their way into equity. So we're using two different channels here. One being net income, retained earnings, and the other being translation gain, other comprehensive income, which is sent into translation reserves. All right. And for the sake of good order, we should always verify that total equity and liabilities is always the same as assets, which they are happily. So it seems that we've been able to close the books in an accurate way here. All right, but unfortunately, the net monetary position doesn't determine how net income is responds to gains and losses from translation. It's an indication of it, and sometimes it coincides and will actually determine it, but there are many exceptions to that rule, which we will talk about in another video then. I mean, to know the exact net income sensitivity to translation risk, we'd have to adjust it in a few ways, but we'll save that for later, and we have a few conclusions for now. So the net monetary position, the net of monetary assets and liabilities, is what drives mainly then the translation gains and losses reported in net income. You get that by subtracting monetary assets you subtract the monetary liabilities from the monetary assets. And you do this on a currency by currency basis. So we have to map this out for each of the currencies we're exposed to. And monetary assets and liabilities is essentially money and various sorts of payables and receivables, where there's a contractually stipulated amount involved to change hands at some certain point in the future, right? So it's largely equivalent to money in that sense. And all right, so yeah, those will be the conclusions now. And as always, please find more information in my books, Corporate Foreign Exchange Risk Management and Empowered Enterprise Risk Management, or my webpage, riskbutton.se. Please like and subscribe. Have a good day.